Hello, fellow traders, and welcome to the market update. This is your instructor, Scott Cook. Today is Sunday, February 4th, 2024, and let's start out by talking about the market. Let's talk about what happened last week. So here's a chart of the S&P 500. I'm using the SPX, and we're going to zoom in a little bit closer on the more recent activity. Let me go ahead and open up the right-hand side of the chart just a bit. We're going to open it up by about a month. And there you go. So you can see this big red day. That's Wednesday, January 31st. And part of what happened this day was lower guidance from Microsoft and AMD on their earnings. The market didn't like that. Opened up a little bit down. And as we zoom in, you can see that it gapped down. Again, guidance from some of the big players started it off bad, and then this was the big day. This is the day that we were looking at. Last week, I did the market update as well and mentioned that, we might be a little overextended. We could be due for a pullback, and watch for what happens on Wednesday with the FOMC meeting. Well, Powell announced that a March rate cut was unlikely, which caused stocks to get smashed even lower. They stabilized a little bit, about 30 minutes before the close, but then they got pushed back down again. Now, I'll admit, on Wednesday, that was the catalyst I was looking for to give the market a little bit more of a pullback after being so far overextended. And also, I forgot to mention that Google had guided lower the prior day also, so that was part of the reason we had started out a little bit lower for the day. But you'll notice what happened the next day on Thursday. We get this big jump right back up. We gain all that lost ground, showing all sorts of resiliency and strength in the market right now. So here we are again on Friday, closing at all-time highs. Again, we saw Meta and Amazon have blowout earnings. Here we see Amazon's earnings. Amazon came out with earnings on Thursday, and you can see that they were blowout earnings, and it jumped huge the next day. The analysts were estimating they're going to make 81 cents per share, but they actually came in at $1 per share. Same thing with Facebook, aka Meta. Great earnings. They were expected to make $4.83 per share, and they made $5.33 per share. So those two tech giants having really good earnings, super bullish for the market. Those big tech earnings plus this job report. Look at all this job data. The average hourly earnings month over month forecast at 0.3 actually came in double that. Plus your non-farm employment change came in double the forecast there as well. If we go into it and look at the news here, you can see that all this employment data blew away expectations. And since it was twice the average forecast, it kind of confirmed the Federal Reserve's reluctance to endorse what the market thought was going to be a March rate cut happening. So it was a really interesting week last week. We had, the big meeting on Wednesday. We had all that unemployment data on Friday. We had all these big tech companies coming out with their earnings announcements. Next week is set to be a little bit more relaxed. Not as much is happening, and we'll get to that in just a second. But I want to take a look at this CME FedWatch tool, and as you go down and you look at the expectations for next meeting in March, which is in 45 days, 1 hour, 52 minutes, and as of right now, 47 seconds. Well, the expectations used to be much higher that we're going to get a rate cut. Now, those interest rate traders are trading as if there's going to be about a 38% chance that they're going to cut rates. If you look at the probabilities a week ago, they were trading as if there were going to be about a 46% chance. And a month ago, the market was expecting about a 62% chance of rate cuts in March. Now, the market doesn't think that those cuts are going to happen. A lot of it's because these big earnings and unemployment data. But at the same time, we're still seeing some stress on regional banks. And the market is looking to inject liquidity into them. And that liquidity comes right back into the market. So March is kind of setting up for potentially a bullish market. We'll see what happens. We're still overextended from a technical analysis standpoint. But let's take a look now at the calendar for next week. So I'm going to go up to the top here and just click on the arrow over, and there's really not a whole lot happening. Tomorrow, Monday, you've got some ISM services. And again, if you don't know exactly what that means, you can just click on this little folder over here to the right. And I like to go down to the Why Traders Care section. It just says it's a leading indicator of economic health. Businesses react quickly to market conditions, and their purchasing managers hold perhaps the most current and relevant insight into the company's view of the economy. And so these guys are paid the big bucks to know what's going on because they're making all those purchasing decisions. So what the big wigs are expecting out of the market is probably important for us to see as well. Nothing really going on Tuesday. You got this economic optimism report, but that's something that I wouldn't pay much attention to, even if this indicator right here was saying it had high impact on the market. A lot of these sentiment type surveys, from a statistical data standpoint, they don't really have much impact on the market from what I've found. On Wednesday, you have some FOMC members speaking, but again, we've heard just about all we really need to hear last Wednesday. On Thursday, again, you have another member that's speaking, and you've got some bond auction activity. But this week should be pretty relaxed. I wouldn't expect any huge volatile moves, but again, we are overextended. No market or stock goes straight up or straight down. So even though we're overextended, doesn't mean we can't have a little bit more of a move higher. It's these big moves that tend to make you the most money in the stock market. So, hey, go with the trend, but it's always okay to play it safe, tighten up stop losses, lock in profits that you're happy with. A win is a win. Keep your ear to the ground. Know what's going on with the news out there in the market. Don't necessarily trade based on the news. Trade based on your rules, the signals that you're using. Number one, the most important thing is the trend, and the trend is up right now. Number two is support and resistance. We're well above any support levels right now, and being at all-time highs, I don't necessarily see where resistance might be. So one of the things we could do is look at previous highs and lows. So looking at the SPX right here, we had a low at about 46.85. We had kind of this channel, a high at about 47.87. So there's 100 points. If we're coming up off of a support level, 100 points above 48.51 would be 49.51, and we're already above that. So maybe 100 points above where we're at right here could put us up in the 5,050 area. Again, we're in uncharted territory at this point. My MACD indicator right now has given us a green arrow showing signs of strength. It's not heading down or anything like that, so we're not losing momentum in the price right now. And looking at this relative strength, it's heading up into the overbought region. But if we hit a major trend, it's going to go overbought, and it's going to stay overbought for quite some time. So no major negative signals on my charts. Everything's looking pretty good. So go out there and good luck. Happy trading.